Hello, welcome.
One sec.
How are you doing? How is work?
Fine. Wait, I can't see anything or anything. One sec. I gotta join back again. Alright.
You can't see my screen?
Hold on. It's not like I can't see this thing now inside your screen. I was saying it before. Like, you try to log me out and let me try to join again, please.
Okay.
Yeah.
Can you see my screen now? Mute your mic. Can you see my screen?
Yes, I can see your screen. Can you hear me?
Yeah. Okay, let me.
You're recording it, right?
You see it?
You're recording it, right?
Yes, I am. Let me clear all this. In our last class, we talk about market structure. Talk about market
Mm-hmm.
structure. We talk about market structure, the patterns, or the flow of the current flow of the markets. When market wants to go from one zone to another zone, the pattern it makes to approach those zones is called market structure. This is the kind of structure market makes when market wants to approach those zones. The patterns or the current flow of the price is called the market structure. We said market structure is when buyers and sellers are what accumulating or what's exchanging. The market buying when market's buying or market selling, two things is happening. One, there's exchange, there's transactions between buyers and sellers. In some point in the market, buyers will take over. From here, see buyers take over. They started buying. When it comes to what a premium zone, that's when this exchange between the buyers and sellers. Now sellers take over to keep pushing the market towards the original direction where price wants to go. Price doesn't go normally like this. What just happened on gold? See price just go from here to that zone aggressively like this. This we don't call this what a healthy movement of the market. So even if market wants to keep buying, it must come back or sellers need to come into this market, push price down. Then from there, what we expect markets to keep buying to follow the what original trend of the market. Do we talk about point of interest where we can use? We said we have two concepts: the concept of continuation, then the concept of reversal. We said most of the time, concept of reversal happens only in two zones. When market wants to what, change direction, it's either at the end of it what trend or what at the beginning of a trend. These are the only two zones where we can catch the concept of what reversal. But most of the time, we catch concept of continuation when market wants to keep buying. When we know the direction where market wants to go, where market is targeting, Then we use the concept of continuations to catch the market to continue from where it was going. If we talk about directional bias, we will find a support where zones, we call them killable, higher time frame zones, where we expect markets to reverse. When market report comes to those zones, when market comes to those zones, we know what sellers waiting at that zones. From there, we expect what markets to change direction. So before market approaches those zones, we have to find a way to what? It's either we wait for markets to come there, give out a market structure shift, market tell us that it wants to sell from there, then we catch the reversal, or we what? We follow the market to go to that zone. This is the only thing we needed to see in high time frame to know where is the draw or liquidity, where market is targeting, where market wants to go. If we know the direction where market wants to go, then we follow the market to go along with it. Can you hear me?
Yes.
So we use market structure. We use market structure to determine the kind of structure market's making to what? To go between this zone to that zone. We have two zones. This, if you marked, when we come to directional bias, this is a key label. This is where market is reacting to another zone here previously. So this is a key label where market wants to buy. So the next target where market is targeting is that high. This is called its draw or liquidity. So since we know markets will go all the way to these zones before we expect markets to reverse, then from here we expect markets to reverse, and we started seeing a market structure shift. We talk about market structure shift, right? Then we expect markets to sell and follow this draw or liquidity. But how do we catch the continuations? There are multiple rules. There are 4 rules when it comes to catching a continuations. The first rule says there must be a break of structure or market structure shift. If market is trending off, the first rule says there must be a break of structure. If we're catching continuation, there must be a break of structure. When market break a structure, and the second rule says what? We must have an inducement. There must be an inducement, or there must be a liquidity. That's when we're going to talk about today. I'm just recapping this so that when we started talking about liquidity, you understand what I meant. There must be a liquidity protecting your zone. And the third rule says what? Pick your point of interest. Your point of interest must not be mitigated. You might have different point of interest. We have this breaker block when we want to catch this continuation. We talk about breaker block as a point of interest, right?
Hold on. Let me ask one question, please.
Okay.
This your inducement, right?
Yes.
You know this your inducement caused another breakout, right?
Yes.
But most of the time, with a lot of things I've seen, right? Let's say we have a week. Let's say we have a week in that resistance zone there that the market is trying to break out, where the inducement wants to break out. I don't know if you understand. No, the upside, where the inducement wants to break out from.
Here?
Do you understand me? Yes, good. Let's say we have a week there.
Mm-hmm.
So let's say when this inducement did the breakout, let's say you only break out the body of the, I mean, the body of the candle, but not the wick. Is that still valid? Is the inducement still valid?
If
Because
it
most of the time that will happen.
if it breaks above this here,
Yeah, but you didn't break out the wick. Let's say there's a long wick there.
okay. Let me show you 2 examples of why some mistake people make when they're choosing their inducement.
And I'll always be happy if you could show me all this in chat, because showing all this in this thing without the chat, it's
Yes,
not
I'm
really
going to
helpful.
show you in chat.
Yes.
No, this is not an inducement. Some people mark this one, say, okay, that is break of structure. This is an internal structure. Anytime market breaks an internal structure, we don't consider it as an inducement.
Oh, you want it to break out full out.
Yes, that's one mistakes people make as what when they were trying to find their inducements. It needs to break out to external liquidity. Do you understand?
I can hear you.
Hello?
Yeah, I can hear you.
And another types of inducement people like make use of it and it's not valid is that when you have a market structure like this, you have a breakup structure like this, then you have a fullback, then people would say what, oh, this, they mark this one as the inducement, this one. This is your external liquidity. This is the external breakup structure. Your inducement must what? Break this zone. So when market come back, then it's what? Make this your inducement, valid inducement. Then you look for your what? Point of interest closest to this inducement. This is what I'm going to talk about first before we started talking about liquidity. I want to explain it on here, then I'm going to show you in the chart.
Okay.
So our first rule when it comes to picking a point of interest, we say that there must be a what? Breakup structure. If we are following, we know the draw or liquidity where market is targeting, the zones where we expect a reversals to happen. When we have two zones here, so we'll be expecting what markets to come to the zone. This is about draw or liquidity, right? So we know that market
Mhm.
is trying to go to these zones, but we want to catch the continuations. That's why I said we use concept for continuation much more often than we use concept of reversal. So if you want to catch these continuations, there are rules that what we follow when we want to catch this continuation. The first rule says there must be a breakup structure. If we have an existing breakup structure, this we know that this market is what? Bullish, right? You have a breakup structure and you have another big breakup structure. You have breakup structure. And you know that market is targeting this high. This is your draw liquidity. So you know that whatever happens, any types of patterns market makes in doing in here, you know that our what final draw or liquidity is this highs. So when you know that market is actually bullish, market is making structural higher highs and higher lows, higher highs and higher lows. You know that it's like your bias, market is definitely bullish. So you want to catch continuation to target these zones. This is your draw liquidity. So the first rules you must follow is what? We say there must be a breakup structure or market structure shift. Market structure shift is when market is making series of lower low, lower high, lower low, lower high. So anytime market breaks this low, this is where we get a market structure shift, right? So the first rule says there must be what? A market structure shift. If we have a market structure shift, it happens when market wants to change trend. So if market is making lower low, lower high, lower low, lower high, the first time markets take out the recent high. So we have a market structure shift. Then we look for the second rules. Says there must be a liquidity. There are three types of liquidity we want to talk about today. It says there must be a liquidity. And then the third rule says your point of interest, anytime you have this market structure shift, you must have two or three point of interest because this high that the market just took out come a breaker, right? Can you hear me?
Yes.
And we have another point of interest here at the other block. We
Mhm.
have a market structure shift here when market take out this zone. So then our second rule says what? We should have an inducement or a liquidity. We must have a liquidity. Then anytime market creates some sort of liquidity, we don't know which types of liquidity market created, but if market creates an inducement liquidity, then we look forward the point of interest, which is our point of interest. We have two, the breaker block and this other block that is close to our inducement. We know that market is already bullish and market what needs liquidity to keep pumping off. So anytime we what expect markets to buy, then we what want to have a clear inducement. This is when people make like they what mark any fullback as an inducement as what they choose the fund of interest close to that fullback, and then markets takes them out and what use the other zone. If market did not give you some sort of inducement, then you look for the other two types of liquidity, the trendline liquidity or what? The engineered liquidity. If market did not give you and you have a clean breaker block, so market is definitely going to manipulate price and use this breaker block as what? The inducement, then buy from there. But if you have a clean inducement, then the fund of interest closest to your inducement, what is your what? Zone. These are the fourth rule. The first one is there must be a market structure shift. This is where we get our market structure shift. Then we must have an inducement. This is the liquidity we have. Then our the third rule says your point of interest must not be mitigated. So anytime market is creating this inducement, we want to make sure this inducement did not what? Tapped this zone, even with a wick. So that means this zone is what? Pressure is unmitigated. Anytime market wants to create this inducement and market tapped this zone, we don't consider it was as an inducement. This zone is mitigated. We call it mitigated block. We're going to talk about mitigated and unmitigated zones. So anytime we have a mitigated zones, this zone is called a weak zone. Market already bought from there. I explained this to you on our last class. So anytime market returns to those zones, we don't expect markets to buy because the probability of what institutions to place another order here is nearly below 30%. So that means they can manipulate price and use this price as what? Inducement, then buy from these price zones. So the third rule says your zone must not be mitigated. Make sure these zones is not mitigated. We have two zones, unmitigated zones, the breaker block and the order block. Then from there, markets, our fourth rule says we have to choose the point of interest that is close to what? Our inducement. That means the breaker block. Anytime we want to catch a continuation, we hardly catch it from order block. Not because market did not what? Come here. It's because most of the time we have a breakup structure. This is when we have inducement. Anytime you look at the chart, breakup structure, after a major breakup structure, this is when we what? Have the inducement. Sellers will say, okay, market already break a structure. It take out what it needed. Now it's time to sell. And it started selling. Then buyers just jump into the market and push the price up. So these two zones, these are the four rules we must follow. We followed when you're choosing a point of interest. There are the other types of liquidity. The one we're going to talk about, which is what the most common one, is what trend line liquidity. We know that anytime market is buying or is selling, there is transaction happening between buyers and sellers. Anytime market is taking out liquidity, it's creating another liquidity. If you can see from here, this was a zone. This is a what? An order block. This one self is an order block. This one, the all liquidities. As market is taking them out from here, market is taking them out and market is creating another liquidity. This high, this high, this high, then this high. So we know that this high that the market just recently developed when market is taking out these lows, these are what our trend line liquidity. Market is creating liquidity as what the structure is going. Market is bearish, so the structure is what bearish. So market is creating liquidity. So anytime we approach a zones where we expect a what reversal pattern, where reversal what will happen, then from there, we know that even if we do not have inducement, we know that market is going to what do the same thing when it was coming down. So these zones, this trade line liquidity are much more important when it comes to our picking of interest. Because we know that market is after, there's something market wants to be after, which is what? These liquidities. Then we can take advantage of that to look for what? Our market structure shift, since we will know that market is already downtrending. Then we look for what? Our market structure shift, which will happen when we type a key label. We call it these zones where we expect markets to reverse. Anytime markets take out this recent low, then we have our what? Our market structure shift. Then we want to what? Consider our what? Liquidity. if we market generates a some sort of what? Inducement liquidity, then we use what? The zones that is closest to our liquidity to what? To catch the reversal. But if it's reversal pattern, most of the time this thing happened in order block. The reason is not because market did not break a structure, is because we will not have clear inducement when market break this structure. Even if market give us an inducement, this inducement most of the time it what? It tapped this zone. It already mitigate the breaker block. So we know that this is invalid for us to trade from there. That's why most of the time continuation comes from what? An order block. Then we expect what? Markets to clear this liquidity that is generated when market is selling. This is one of the components we talk about. So the liquidity concept I'm going to talk about is what will go on to determine where to set your take profit and where to enter the market. Do you understand?
Yes.
Let me show you something on the chart before we continue. Let me find the structure that what I just did explain to you. I explain what trailer liquidity is, right?
Mhm.
Explain what trailer liquidity is. It's when the liquidity market makes when it was approaching zones, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. These are called the trailer liquidity. Right? So next time market wants to what? Change direction, we expect markets to clear this trend line liquidity before market what? Wants to find another zone where market wants to do something different. But the first thing when market started selling, we expect markets to clear this trend line liquidity. This is our draw on liquidity. So anytime we know that market tapped into high time frame key level, when we go to direction about we want to talk about. So we expect where we expect the reversals to happen. So let me show you somewhere that it is fundamentally happens. But let me show you somewhere that's actually tapping these kinds of zones. Okay. I want to show you somewhere that's actually reacting to a zone. I want to find a zone where markets,
Once it doesn't happen all the time, right?
it happens all the time. Let me just so that so you see, this is gold. So gold is at all-time highs. I want to find a zone where market actually reacts to a zones, then started selling. So catching this, gold has not been, okay. Let me change the time frame. I want to explain the concept of reversal because it happens when markets what tapped into key level, high time frame key levels. We want to see where markets reacting to first. Okay. Can you see here? See, market was actually buying, making series of what? Higher highs, higher lows, higher highs, higher lows, higher highs. We know that market is what? Expecting what? This is a zone. The reason why I mark this one is just that the first section of gold, because it was as all-time high, is not that clear. So let me try if it is not clear. I'm going to change it to BTC. So this zone, this breaker block, it was what? A key label that when markets reacting to. When anytime markets react to this key label, I explained this. This breaker block is a key label. It's a high time frame key label. If you go to 4 hours, you know that you see this zone is actually a key label. This is where we expect the reversals to happen because we see already market what breaking a series of lower low. From here, this was the last low market makes. This one, right? Can you see?
Mhm.
This is where we will have for what market structure shift, right?
Mhm.
This is why we have our market structure shift because market was bullish, and then we have a what? This is our recent low that market makes. This zone is what protecting our what? Trending uptrend. So anytime market breaks this low, we expect a what? Market structure shift. And it happens, if you can see. Market breaks it. Then we look for what? Our inducement. Then we look for what? Point of interest. The reason why this zone here, this high, it's not what is at all time high, it's not respecting, it's not what this is what fundamentally happened because this gold is not at ATH, it's at ATH all time high. There's no zones that we expect a reversal, right? Since market is already at all time high, that means we do not have any zones that we expect reversal. Do you understand?
Mhm.
So
Mhm.
we just have to wait for these reversals to happen on its own. Anytime we break one of these low, then we know that reversal wants to come in. This is all-time high. So market what finally what starts selling. So we had a what breakup structure. We have multiple breakup structure. If you can see, market take out this our first low and it take out this zone. We have what two breakup structure. This is when we have our what inducement. Oh, sorry, market structure shift. So that means automatically this breaker that causes this market structure shift is what one of our point of interest. And then this breaker also is one of our point of interest. Then this other block of there is also one of our what, point of interest. So we have 3 point of interest we can choose from this, as you can see. I'm using high time frame. You can see this much more clearly in lower time frame. Even recently on charts now, you can see them, not just previously. You can see it anywhere. This is 4 hours. If you go to 5 minutes, you see the same thing. If you go to 1 minute, you see different structures. It happens in different types of time frame. So these are the 3 zones we can what look forward to sell because we have a market structure shift. We know that the what uptrend is over. We want to what keep selling. So this zone is our what breaker block, and this also is the other breaker block that market just disrespected. Our recent low that the market disrespects, and then we have our original order block. Then our second rule says we must have an what liquidity. It said that can be a trailer liquidity or what it either can be a trailer liquidity or it can be a what. I'm asking you.
Mhm. Engagement liquidity.
Yeah, it can be an inducement liquidity or engineer liquidity. But we what this is where reversal happens from this other block. This other block. This is the other block that cause force this cell. Then we break a structure to the downside. This is our structure. We have multiple breakup structures. Then our second rule says we must have inducement. Where is our inducement here if you can see clearly? Do we have inducement?
Oh, the week there.
You said?
The, the inducement around where? After the MSS, right?
Inducement is after a breakup structure. Any structure that market breaks. This zone, it go broken, right?
Mm-hmm.
And then this our zone again. This break also this zone, this low also go broken.
Yes, this is the middle here is the inducement. The
Yeah.
entry is here. The entry is here.
Yeah. Then this is our inducement.
Yes. But good now. Look at this inducement now, right?
Yes.
The first pullback.
After
It
the
didn't break out this week, oh. It didn't break out this week, oh. That's what I'm trying to tell you.
it did with a body. See, look at it clearly. Is that
I
it
mean,
did
this week,
this
this
third
one here.
this third zone, this third one is the one create our inducement.
Mhm. Look at this thing I'm trying to tell you.
Which
The
one?
week here, look at the week below.
This one.
No, yeah, below, down, down, down.
This one.
Yes, yes, it didn't break it because after the inducement, this is we have like the candle here. I thought you said he has to break out from this week entirely.
This is our low, right?
Mm-hmm.
This is the other block that we have. This one was the other block because it calls this break of structure to the upside.
Mm-hmm.
Then this is the other block. This is our low that we expect markets to break, and market did
Mm-hmm.
break it with this
Now
complete.
we have
This
now
one,
the inducement.
yes, the
Mm-hmm.
inducement come back after we have a break and closure. This candle close inside a complete break
Mm-hmm.
of structure.
Mm-hmm.
Then market go back off and create this inducement.
Mm-hmm.
Then we mark it as inducement. So then we
Mm-hmm.
look what for this our point of interest. We have 3 point of interest.
You see, this is where the mistake happens now. When you were doing it on the normal chart, on the normal line, you will say he has to break out this any week below it. That is one. Because most of the time, the way I see it, this is exactly how I see it. I don't see it breaking out this. Oh, let's say out of like 20, maybe I would say maybe five. It breaks out this maybe the
Let me show
last week.
you.
Maybe.
If you go to lower time frame, let me
Mhm.
let me try one now. If sometimes structure is not clear for you, you can change your time frame. You can see it very much clear. Let me show you. Where are we? Look at the inducement. If you mark a breakup structure, do you mark it with candle or wick?
I do the week for break of structure.
Breakup structure, you did wick.
I do a mark, it has to completely break out the week here. We have a break of structure here, good.
This is the breakup structure. This is the low, right?
Mm-hmm.
That you have a breakup structure.
Mm-hmm.
Then this is where market what go back or from here. Is it from here? You mark it from here.
For what?
You said you marked your inducement from what? Your breakup structure with a wick.
It's okay. What I'm trying to tell you is that after my break of structure, right? He said the first candle, right?
Yes.
That pulls up, and he has to come and break out any this thing that is. I don't know how to explain it, but
Yes,
he
I
said
say your
the
inducement should break up the last low or go at least 50%. Did I talk about
this
that?
is this is yes. You've talked. I don't think you talk about it, but I've watched some other videos that they say 50%. That is why I'm confused there.
But I
So
did.
yeah, this is the last low, right?
Yes.
This one is the last low. Oh, and touch the last low, please.
This one?
Yeah, the week here, that was the last low market
Yes.
created, right?
Yes.
So when the inducement went up, this is our inducement here. Touch the inducement, please.
Yes, this is inducement.
Good. You know, it didn't break out this last low.
It did
You
not,
see, it didn't.
but it go more than 50%. It must retrace back 50% or break below it.
That is what I'm trying to say. That is why I was asking you that question. Because most of the time, I've been picking some trade nowadays that the inducement might just go up a little bit, then just cause maybe I just make sure there's a breakout, like
That's why
you
I
know,
just that's what I explains to you that when you have a what breakup structure, then you have another inducement. This inducement, I said tell you this one is not inducement because it must go at least break this one because you have an external high. It's either break this external high or
Mhm.
break this high. This if you can
So
You said?
Okay, I can hear you. I can hear you. I can hear you.
Then from there, we look for a point of interest. We have three point of
Because
interest. This
because
zone,
when you were explaining this thing, you said this will be internal structure now. That was what you said like some minute ago. So I was confused that markets don't usually come and break out the last low. Most to me, what I've seen, the only time I've seen that the market that you told that US 30, that inducement was really, really clear if you could remember. If
yes,
you can go on your WhatsApp and remember, it was clear. But I've also been doing some back testing and all this but most when I see it, it doesn't break out the last low sometimes. All you just do is come up maybe 50%. You understand me, right? Then push down. So when you were saying it, I was like, oh God, what is happening again? You understand? Because I was all confused. But now I understand.
there's one thing when that's why when you come to markets, we know that sometimes if markets tapped into key level, where we expect a reversal. That is different between when market is not reacting to any key levels.
Mhm.
When you want to catch a continuation, you want to catch a sell inside of bullish market. That doesn't mean the sell is not going to be valid. It's just that the sell is not coming from any key level.
I get. So this there's one thing I do is when I'm trying to mark my point of interest, right?
Yes.
Because now there is something that I've been doing. I don't know if it's something that makes sense, and I'm gonna show you my chart. There's
Okay.
something that I have. I don't all this analysis you are doing right now.
Yes.
I've watched a lot of videos about this. Maybe that Tony I video. It says a lot of things about this thing, but I feel like I've been paying attention to this thing most of the time. But you get confused, even if you're not really good with what you're doing, right?
Yes.
But since you are good with it, that's why you understand what is going on. So I just try to just break down my own this thing too. I wait for higher time frame key level most time for maybe daily.
Mm-hmm.
Then from daily, let's say I look at the direction of the bars with the little knowledge I have, the direction of the market itself. You
Mm-hmm.
understand?
Mm-hmm.
I just wait for tap. I just wait for maybe other block there. That okay, this other block is okay. Then I just wait for market to tap into it. Then when market tap into it,
Then you
I
have
go to my
market
lower
structure.
time frame. I go to my lower time frame and just look for what
Market
structure,
structure
liquidity,
shift.
and all that, and see how it goes.
First,
But to me,
you need to look for market structure shift.
that's something I go for lower time. Is it market structure on that same daily time frame
Yes,
or lower time frame?
that's zones that market tapped into. If market tap
Mhm,
into these zones, this zone, this is a daily
mhm,
zones, right? Where market is reacting to.
mhm,
Then you go to lower time frame to look for market structure shift.
on 4 hours.
Go to let's say 30 minutes. What is your recent low?
One sec.
Is this not the recent?
So
This one is
that is the last.
this
Hold
is
on.
this is the recent low, right?
Mm-hmm.
Market breaks above it and you have inducement. Is it a valid inducement?
Which one?
This
This
one.
one is a valid inducement because it
Then you
caused all
have
this.
what? Two zones. You have a breaker block.
Mhm.
You have another block.
So now the breaker block that you mark, I don't pay attention to the week. Me, I don't pay attention to the week.
Go to lower time frame. Go to 15 minutes. You see it
I
clearly.
clearly, right?
If you don't pay attention to the week, then you go to lower time frame. You see it much more clear.
I do the body because I don't. You see, no, you now you mark the week, right?
Yes, I mark the complete body and the week. If we have a week, if our candle has low, with the week is small, we marked all of it.
Okay.
But if the week is
Okay.
too high, that's when we mark only the body.
Okay. Okay. I get.
Then
I
from
get.
here, you see you have your market structure shift here.
Can you draw the chart pattern on this for this market? I want to see it clearly. No, from the up. No, no, from the
Okay.
up. Like, yeah, just from that place. Just is okay. I
Mm,
just want to see it clearly. Mhm. Lastly, created.
damn.